Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tune in into this episode, number 402. The title is Don't Get Killed on Taxes. And I have a special guest, Steven Jarvis, who I'll be bringing on the show today. Before we get started, I always like to start the day right by renewing our mind, and I've got a verse here for us from 1 John chapter 4, verse 18. There is no fear in love, but perfect love drives out fear, because fear has to do with punishment. The one who fears is not made perfect in love. How do you count cows in a field? With a calculator. What do you call a polar bear in the desert? Lost. Most people tell me that they don't mind paying their fair share in taxes, but they don't want to pay more than their fair share in taxes. If you're interested in strategies to reduce your taxes in retirement, I think you're really going to love this episode. In today's podcast episode, I interviewed Steven Jarvis, who is the co-author of the book, Don't Get Killed on Taxes, and the host of the Retirement Tax Podcast. We talked about how to pay less money in taxes on your Social Security income, when do Roth conversions make sense, sneaky shadow taxes you need to watch out for, how your income and withdrawal strategy can impact your Affordable Care Act credits, the triple tax savings of HSA accounts, QCDs for tax planning, and long-term capital gains and depreciation recapture when selling rental properties. As always, articles, links, and resources are available at soundretirementplanning.com. Just click on episode number 402. And as a reminder, my new book is available on Amazon. Just do a search for Retirement Calculator by Jason Parker, and you will find the book. Here's a recent 5-star review from Gordon. He says, for several years, I've listened to Jason's podcast, Sound Retirement Planning, and used the Retirement Budget Calculator. Both are excellent. Retirement Calculator is a super easy to follow book with a wealth of practical information on financial planning. I'm a certified financial planner, CFP, and wholeheartedly recommend this book. Thanks, Gordon. If you enjoy my new book, be sure to leave us a review on Amazon with 30 other people that have done so. And without any further ado, here's my interview with Steven Jarvis. All right, it is my good fortune to have Steven Jarvis on the program with the Retirement Tax Podcast. Steven, so happy to have you on the show with us today. Thanks for being here.
I'm excited to be here. I love talking taxes, and I can say that with a big smile on my face and all the sincerity in my heart.
It's actually one of the favorite topics of the people that listen to Sound Retirement Radio, especially around this idea of making the transition into retirement. I've got your new book here in front of me, Don't Get Killed on Taxes. And I've read not all of it, but some of it. And I'm looking forward to having a conversation with you about some of the ideas you shared in the book, as well as just some big picture stuff. So tell me, as you talk to people that are making this transition into retirement or people that are already retired, what are some of the concerns that you hear from the folks that you serve?
You know, Jason, as luck would have it, well, maybe not luck, I spent a lot of time working on this stuff. Just before we got on this call, I was working with a taxpayer who just retired. 2022 is their first year in retirement. And we didn't have a chance to start working together until after the end of the calendar year. So we're looking back at 2022 and helping her understand what happened. And there's a lot of misinformation, just a lot of misunderstanding for people getting into retirement about Social Security and how it's taxed and how the taxes get paid and how much of it's going to be taxed and the difference between how it's taxed at the federal and state levels. So that one's top of mind for me, and it does come up quite often, especially in that first year that people are pulling Social Security. I see far too often that people get surprised by a tax bill at the end of the year because they didn't realize how much of Social Security would be taxable.
You know, this topic of Social Security and taxation is a fun one because originally when Social Security was originally made available, it was not a taxable benefit. And then I think it was under Ronald Reagan that it was initially taxed, and then Bill Clinton increased taxes on Social Security. So help our listeners understand, how is Social Security taxed? What's the most of your Social Security that could be taxed these days?
Yeah, so depending on your income, up to 85% of your Social Security can be subject to income tax at the federal level. And I'm emphasizing federal there because each state has their own set of rules and it really varies.
Mm.
Some states don't tax Social Security at all. Some states tax it only at certain income levels. Some states just tax it across the board. But at the federal level, which we'll focus on today, up to 85% of your Social Security can be taxable. And where some of the confusion comes in is that as little as 0% can be taxable. It all depends on your total income for the year.
Yeah, and somebody taught me once, they said, Jason, sometimes a small hinge swings a big door. And this is one of those areas where with tax planning and when you are trying to determine how to take withdrawals from your portfolio, you can really have a big impact on the taxation of Social Security. What are some strategies or some things people should be thinking about regarding the taxation of Social Security?
It's a good question, Jason. So much of taxes are situational, right? Just like most of what we talk about when it comes to retirement planning, there's these kind of broad strokes that we like to paint with. But at the end of the day, we got to get really specific for an individual person. So for a lot of the clients that I work with, we don't spend a lot of time focusing on how do we impact how much of Social Security is taxable, just because that top dollar amount for up to 85% being taxed really isn't that high for people who have done a really good job saving for retirement. For in 2022, for someone who is single, it was income over 34,000, and then your Social Security is taxed 85%. And for married filing jointly, this is one of those areas where it doesn't just double; it's actually only 44,000. And so, for a lot of the clients I work with, we focus more on making sure we have a strategy for paying those taxes, so that we don't end up with underpayment penalties. But for clients who are in that range where the amount of their IRA distributions or the amount of capital gains or some of these other things that we might be able to have a little more influence on, if that's going to affect how much of Social Security is taxable, it's absolutely something we want to include in our projections, in our analysis of what makes the most sense as far as timing of income.
Mm-hmm, mm-hmm. Things like interest income can impact the taxation of your Social Security. So if I remember looking at some tax returns over the years where people had just a ton of money in CDs that was kicking off a bunch of interest income, causing them to pay more money in taxes on their Social Security. That's one area that we find. Taking money from IRAs versus Roth IRAs, where you've got that tax-free income, can affect the taxation of your Social Security. So just some, people oftentimes aren't really thinking about the implications of where they're pulling their money from. And I wanted to ask you about that because there's a couple of topics I found around this idea of retirement planning that are really important to people from a taxation standpoint. And one of them is this idea of doing Roth conversions. And you have some information about this in your book. Talk to us about, do Roth conversions make sense for people heading into retirement? What's the best strategy around when to consider Roth conversions?
Yeah, there's a lot to unpack when it comes to Roth conversions because, and this is a great question to bring up because there's so many headlines, there's so many things on the internet, on social media, on podcasts like this about, oh, hey, everyone should do Roth conversions. You meet a lot of people who push these endlessly. And I get where they're coming from, it's something I work with clients on quite often. I think they can be a great strategy. But like anything else, it depends on the situation. So some things I start with when it comes to Roth conversions is we want to have a conversation around what are your expectations about tax rates in the future? Because Jason, I know you know this for your listeners. At the end of the day, Roth versus traditional IRA, which one makes more sense from a tax savings standpoint, all comes down to tax rates in different years. If tax rates never change, and that's either because Congress changes them or your income changes in your different tax bracket, you're going to pay the same amount of tax on traditional versus Roth. There's a whole bunch of nuance that goes into that, but from a very high level, it's tax changes that make Roth so powerful from a tax savings standpoint. So I like to start the conversation with, hey, Mr. and Mrs. Client, are you at all concerned that tax rates might go up in the future? And given where we're at today, my crystal ball doesn't work any better than anyone else's, but most people say, yes, I am very concerned that tax rates are going to go up. In fact, we know in 2026 that tax rates are going to go up. And so that's part of the conversation of, do we expect, either because Congress changes the rates or because you might have more income in the future, that you might be in a higher tax bracket in the future, in which case it would make sense to go ahead and intentionally pay taxes now at what we expect to be a lower tax rate.
What are your thoughts? Do you think taxes are going to go down? We've got $31 trillion of national debt now. The deficit is continuing to grow that national debt. What are your thoughts? Are taxes going up, down, or staying the same in the future?
Yeah, again, recognizing that my crystal ball is just as broke as everyone else's, I personally am putting money into Roth and getting money into Roth as much as I can for my own personal situation, which I always bring that up because I want to be recommending to my clients the same things that I am looking at personally. And so, yes, the amount and timing of those things are going to be situation specific. But when you look at what tax rates have been in the past and where we're at as a country, and even just like I said, we already know that tax rates are already scheduled to go up. And so I have a hard time envisioning that tax rates are suddenly going to go down. And I'll even acknowledge to my clients at times to say, hey, listen, the tax code is written in pencil. Congress absolutely next week, next month, next year could say, you know what, this Roth stuff is nonsense. We're going to get rid of it. Or, hey, we're going to cut tax rates in half. And at that point, if we have to have a really difficult conversation of, you know what, we got this wrong and we're going to pay more taxes, but we did the best we could with the information we had. And that's all you can ever do when you're planning for the future.
Yeah, yeah. There's this, as we think about Social Security, there's still in the headlines all the time, this idea that Social Security is going to have to cut benefits in less than 10 years now, based on just the fact that we have all these people drawing on benefits. And so with that, do you think we could see a tax increase just as a result of trying to keep Social Security afloat?
It's a good question, Jason. I often want, since I spend so much time in this space, I often wonder how we can so consistently have these headlines and that people always feel like they're brand new headlines, because I don't even know what the count is of how many times we've been told Social Security is going to run out, the benefits have to go up, or the benefits are going to get cut, whatever the headline is. I mean, this is just something that repeats itself every couple of years. And I think the reason it always still feels so new and shocking is because you have a different group of people who are now focused on it as they get close to that. But whether it's Social Security needing more funding or any other government program, I have a hard time envisioning tax rates going down in the future.
Yeah, me too. So there's this concept that's out there. I think it was Ed Slott that originally called it the tax torpedo. This idea that for people that are going to be retiring early, say at age 60, and they don't have to start Social Security until 70. There becomes this opportunity, especially if they have non-qualified, brokerage accounts, to pull money from money that's already been taxed, or bank accounts, savings accounts that have already been taxed for the most part. It creates this opportunity to do Roth conversions those first 10 years of retirement. What are your thoughts about a strategy like that, where your income's low when you first retire and you have the ability to start transitioning money out of IRAs and over to Roth accounts?
Yeah, I mean, that's really the ideal, that we would end up with this period of time. And a lot of people do. It might not be the full 10 years, but a lot of people end up with some period of time between their peak earning years and then drawing Social Security and required minimum distributions kicking in. That's usually the other one that drives people's income up in retirement. We end up with these years where we have relatively low income tax rates. And for some people, they might say, well, the government's still taking 10% or 12% or 22% of everything I make. That still feels like a lot. I don't disagree, but it's relative to what were you paying at your peak earning years? What do you expect to pay in peak retirement earning as well? And if we have some years in there where we can intentionally convert, we can say, I'd rather pay the rate I know today than guess at what the rate's going to be in the future. There can be a lot of advantage to that. And even if we don't, I mean, nobody can guarantee that tax rates are going to go up. The other thing it does is it creates tax flexibility. So because not only are tax rates unpredictable, but your life is unpredictable. For all of us, there's going to come a point in the future where we're going to unexpectedly need a large sum of money. And the way I like to think about this is that hopefully it's for something fun, like traveling with your family or buying an RV. It might be for something that's not fun, like a large medical expense or replacing your roof. But having money in Roth creates flexibility if you were to ever need a large sum of money unexpectedly, to have options for doing that without instantly getting killed in taxes.
One of the things that we find people run into, especially if they're going to retire early at age 60, is that they have to pay for health insurance oftentimes out of pocket until Medicare kicks in at 65. And if they're really savvy about where they're pulling money from, they could end up with these Affordable Care Act tax credits to help them pay a lot less money for health insurance premiums from 60 to 65. It almost seems like if that's the case, people would really want to be mindful about maybe holding off on doing those Roth conversions, or really maybe just doing micro conversions from 60 till 65 to make sure that they don't mess up these Affordable Care Act credits that they could qualify for to help them reduce their health insurance expense. And that can be big. I mean, we've seen people pay $2,000 a month for health insurance from 60 to 65. What are your thoughts about that? You know, taking Roth conversions into context with, it's almost like a sneaky tax, the Affordable Care Act credits. You know, if you're wise and you know about them and you have certain accounts you can pull from, it seems like it helps you. You can really pay a lot less money for health insurance than you would otherwise. But what are your thoughts about that?
Yeah, that's a sneaky tax for a couple of reasons. We like to call those shadow taxes, that they're not your traditional income tax, the 22 or 24% bracket, but they're definitely impacted by your income. And the reason that can be sneaky in a couple of ways is like you're alluding to, Jason, it can be hard to even be aware that those are out there. And so it's sneaky on the side of even making sure that you know that you qualify for them and report accordingly. The other thing that can really sneak up on you is that a lot of those credits are paid in advance. And so when you go get insurance on the marketplace, they'll ask you to estimate your income. Some portion of that credit will be essentially prepaid because your premium will be reduced. And then at the end of the year, through your tax return, you basically have to true up whatever your estimate was to what your income actually was. And so I've definitely seen it happen before, where I'm looking at a previous year's tax return for a client and helping them understand how they've ended up wherever they're at. And that we'll see that, hey, they were getting, like you said, it can be $2,000-$3,000 a month of this credit. I've seen it where people are getting $30,000+ in tax credits from this. And then they get to the end of the year and they hear a podcast that says, hey, I should convert all my dollars to Roth. They do this huge Roth conversion. And then tax time comes, and not only do they have to pay taxes on the Roth conversion, now they have to repay this advanced premium tax credit. And now they suddenly have this tax bill that just is mind-blowing to them. And so it absolutely still needs to be considered. It's not, to me, it's not a binary. It's not, if you qualify for the credit, you shouldn't do any Roth conversions, because there's a phase out to a point. And the last couple of years, they actually got rid of the cliff, because it used to be that if you went $1 over the very top end of the income limit, you lost the full credit. And so that's been a little bit of a moving target the last few years with some of the changes with COVID stimulus and different things like that. But yeah, it has to be included in the context of making that decision, because it's big dollars.
Yeah, it really can be. Health expenses in retirement can be a big one, like you just mentioned, and being able to have a tax-free pot of money to draw from could be a good deal. But if people are 5 to 10 years from retirement, we have these health savings accounts now that seem really like they're the best of both worlds. You get the tax deduction when you contribute, and then you get the tax-free growth like a Roth. Take a minute and help our listeners understand how the HSA works, when it may be a good option for them, and should people consider prioritizing HSAs over Roths? What are your thoughts on that?
Oh, that's a great question. I like to look at kind of an order of operations when it comes to what types of accounts are we going to fund. And HSAs do have the highest potential for tax benefit. A lot of times people talk about the triple tax advantage of an HSA, which, as you mentioned, it's that you get a tax deduction as it goes in, which is similar to an IRA, right? We get a tax deduction as it goes in. Then it can grow tax-free, and then we can take it out, and as long as we use it for medical expenses, we can use the funds tax-free as well. So that's where the three benefits come from. Now, we got to make sure that to really maximize that benefit, that we're actually investing those dollars. That doesn't happen by default. I've seen way too many cases where someone's just got their HSA funds sitting in a money market account or something within their HSA. The other thing that people don't typically think about with an HSA, just because of how these are often presented to them, often by an employer, of, hey, here's how you're going to pay your medical expenses. And so people will just use this as kind of a revolving door of, I put money into my HSA, I take it back out to pay for medical expenses. If we have other cash flow that we can use to cover those medical expenses, then we're getting that tax-free growth over time. So, perfect world, we're doing both HSA and Roth. Aside, if we need to pick one or the other, HSAs had the higher potential tax advantage. So that's typically where I'm going to start if we're eligible for them. The other nice thing about an HSA is because we know it's supposed to be for medical expenses, and that's definitely where we get the largest tax benefit. But if by some miracle we end up with hundreds of thousands of dollars in an HSA and we're just the picture of health into our 90s and we don't need those funds, we are able at some point to start using those funds for other things besides medical expenses. We'll have to pay income tax at that point, but there won't be any penalties or interest or anything like that.
Okay. All right. The other thing that I wanted to ask you about is as we're thinking about withdrawal strategies and people are getting ready to make this transition into retirement and they've got brokerage accounts, they've got IRAs, they've got Roth accounts. How do you help somebody understand the best way to take money out of those accounts as they make this transition into retirement? Is there a general rule of thumb that you like to use, or is it really a one-on-one individual type of planning situation?
Yeah, so that's not one I wade into too often. So I'm a little bit unique as a tax professional in that I only work with taxpayers who also work with a financial advisor that's in our community, that's in our network. And so there's some of, especially when it comes to withdrawal strategies, I focus more on I want to make sure that the taxpayer and the advisor both understand what the potential tax implications from those different sources are so that we're making really informed decisions. But I think withdrawal strategies is an area where a lot of rules of thumb get thrown around and then misapplied to individual situations. So I don't have a blanket, hey, start here and then we'll adjust if we need to. We really need to look at your situation and maximize it.
Okay. You used the word rule of thumbs, which I'm glad you did. It triggered another thought in my mind about this idea of when to start Social Security, 62, 67, 70. Any thoughts from your perspective on the optimal time to start Social Security?
Again, I spend a lot of my time on the tax side of this as opposed to helping people make that specific decision. But similar to taxes, I would say, I think we need to keep in mind this idea that we need to figure out what our kind of our life goal, our life plan, what is our highest priority, what are we trying to accomplish, and then figure out the finance and tax pieces to go along with it. Because what I never want to see with Social Security, and I recently had this come up with a client, they were going through all of the math of what would be the optimal time from a math standpoint to take Social Security, which is a total guess because it's all based on your life expectancy, right? Whether it's better at 60 or 62 or 67 or 70 or whatever age you're going to elect it, it really depends on your life expectancy. It's all just actuaries. So this person was going through all of the math, and then I said, let's just take a step back and say, let's ignore the dollars for a second. What would it mean to you if you got to retire 5 years earlier than you'd originally planned? Is the next 5 years of your life going to be significantly better if you get to walk away from work and do the things you're most excited about? And their eyes kind of lit up, and they're like, yeah, I would pay a lot to be able to do that. I said, okay, great. Now let's go back to the math, because here's how much you're going to pay. Does that still feel worth it? And they're like, yeah, that feels worth it all day. Like people get locked in on I've got to get the absolute last drop of money out of Social Security that I can, and they forget, well, how am I maximizing for my quality of life?
Yeah, that's a good point. That's a good point. The money is there to help you live your best life, and if we don't. I've heard it said you don't want to put the cart before the horse, so you don't want to let the tax tail wag the dog, if you will. Yeah, we might be able to help you reduce the amount of money you pay in taxes, but at what cost? And there's always a cost. There's always a benefit and a cost. The next thing I wanted to ask you about, and this is one that we see for folks that are in retirement as a tax planning strategies, are the opportunity to do QCDs. Will you take a minute, help our listeners understand what is QCD stand for, and how are people using these as a strategy to help them pay less money in taxes?
It's a great question. I love talking about this topic. So QCDs, qualified charitable distributions. This is an opportunity for us to get a tax advantage from giving to charities that we care about. And I phrase that way on purpose because this is one of those areas where people sometimes will let the tax tail wag the dog, and they really shouldn't. Because at the end of the day, a tax benefit from giving to charity still means that you're getting some fraction of what you're paying out back as a benefit. So if you're supporting causes you really care about, this is great because we can get a tax advantage and we can help you accomplish other goals. We can give more of that charity, we can fund more trips, whatever it is, whatever's most important to you. If you weren't planning to give to charity, it does not make sense to give to charity for a tax benefit. Because if you want to if you want to pay $1 to save 20 cents, I'll do that for you all day. Send me your money. I'll send you 20 cents back. I've got you covered. So when this makes sense, like I said, is when we're giving to charities that we already support and care about. But the reason it's so impactful, especially for retirees, is because the standard deduction has gotten so high. And so 90% of taxpayers take the standard deduction, which means they're not getting any tax benefit for their charitable giving. What QCDs allow us to do is to give to charities directly out of an IRA. And when we do that, the IRS has said, great, now we don't need to figure out if we can itemize our deductions. We're just going to reduce income. And so now we've reduced our income, which is the benefit we were looking for if we were able to itemize. We've also done a couple of other things because we've reduced our income at a point on our tax return where it's going to help us with things like Medicare premiums. Now the income that is used by Medicare to decide how much you have to pay for your health insurance, that income amount is going to be less, or is going to be lowered by the amount of our QCD.
Yeah, those QCDs, really great opportunity. When do they become available for people? When does that become an option?
Well, since nothing ever really makes logical sense with the IRS, it's at age 70 and a half, which used to line up with when RMDs, required minimum distribution, started, but that age keeps changing. Thankfully, they haven't changed the QCD age. So at 70 and a half, we can start making QCDs. And there are some things we really need to keep in mind to make sure those get done correctly, because it's and these are logistical things. We got to make sure that the funds are going directly from the IRA to the charity. We still need to be making sure that this is a charity that meets the IRS's requirements to be getting a tax deduction. The other thing I see get missed a lot with QCDs is that the custodians, the investment companies holding the IRAs, don't have a great mechanism for reporting to the IRS that that distribution was in fact a QCD. So what ends up happening is that QCDs get made, you've given your money to the charity, and then it doesn't get reported correctly on your tax return, and you don't actually get the benefit. And so making sure that if you're working with a tax preparer, that you're letting them know, hey, I did a QCD this year, we need to watch out for that. If you look at your own tax return, making sure you understand what line that should be coming through on and how it gets reported, because there isn't a spot on your 1040 that just says enter QCDs here. If you don't know what you're looking for, it's easy to miss.
Yeah, that's really good. We have this Tax Cuts and Jobs Act that's getting ready to expire. What kind of things should people be thinking about before tax rates go back up? And what's the timeline that we have to work with?
Yeah, so in 2026, tax rates are scheduled to go up as the Tax Cuts and Jobs Act expires. And the joke I like to make is that if Congress does nothing, which is what they're best at, then tax rates are set to go up. And so, Jason, this just comes back to our earlier conversation of kind of understanding what our expectations are of where we're at right now with tax rates that we're paying versus what they'll be in the future. And so there isn't a single strategy that we say, okay, this is the thing you absolutely have to do before TCJA expires. But it should come into our thought process that we've got a couple more years here before we know the tax rates are going to go up, to do things like Roth conversions, capital gains harvesting, these things where we can intentionally recognize income in a year where we expect tax rates to be lower.
People have been saying for years now that capital gains are on sale. Would you help our listeners understand what people mean by that?
The capital gains are on sale. That's not the way I typically refer to it, but I think I see where you're coming from. The way I look at it,
well, just because of this 0% taxation on long-term capital gains up to a certain point, and then 15%, and the idea that these are historically low and rates for long-term capital gains compared to history.
Gotcha. So I was still stuck on TCJA, but I'm with you now. No, you're absolutely right that we get preferential rates on certain types of income, capital gains, qualified dividends, and this can be a great opportunity to, again, be intentional about when we recognize income. Anytime I see a tax return that has $0 in taxes paid or $0 in taxable income, I think, oh, geez, what a missed opportunity. Because to your point, there's this window, this range where we could potentially recognize capital gains and pay $0 in taxes. And what's great about this is we really don't even have to change our investment strategy to do it, because one of the beautiful things about capital gains harvesting is that we can sell an asset, we can sell a stock at a gain and then immediately repurchase it. If any of your listeners are familiar with capital loss harvesting, there's some rules about how long we have to wait or similar assets. But capital gains harvesting, we can just repurchase it. So if we still are in love with the stock that we own, but it's grown in value, we can say, great, let's recognize the gain, pay 0% tax, pay 15% tax, and then we can just buy it back again if that's what we prefer to do.
One of the areas that is we're starting to see more interest in, and it's a result of the higher interest rate environment that we're in. But a lot of the people that we've run into over the years own rental properties, and they've been great investments for them for many reasons, and especially in retirement, because they have cash flow. That cash flow is usually adjusted for inflation, and they've been depreciating the property. But now people are looking at these properties and they're saying, boy, that the asset price is really high. And if we were to liquidate this asset and go out, could we replace the income with some other form of fixed income? And so as they're trying to make that determination of whether or not they should sell a rental property, one of the things that they run into is depreciation recapture. And that seems like, depreciation is such a wonderful gift when you're depreciating a rental property over time, because it's helping you pay less money in taxes. But all of a sudden, when you sell that rental property, now you've got another issue. We help our listeners understand what happens when you sell something like a rental property, and what is depreciation recapture?
Yeah, I'll do my best to walk through this, hopefully in a way that makes sense to everyone else. So let's start with a stock first, of just the general idea of when we buy and sell an asset, what happens. So if I buy a share of some particular company's stock and I pay $100 for it, and then I go to sell it and now it's worth $110, the difference between those two is my gain. So I have a $10 gain that I'm going to pay taxes on. And if I've held it for more than a year, it's going to be a long-term capital gain. It can potentially be at a preferential tax rate. Okay, so that's a simple example with a stock. But the same general logic applies to any asset. So I buy a rental property, I guess let's start with I buy a house, and let's just assume that it's not a rental property for now. It's still same general idea. I pay $100,000 for the house. I wait a couple of years. I sell it for $110,000. Got a $10,000 gain. I still get these preferred rates. Now, the IRS is really sensitive to people taking advantage of those preferred tax rates. And so what happens with a rental property is that we pay $100,000 for the rental property, and the IRS says, okay, since you're using this asset to generate cash flow, you can depreciate it. You can take that $100,000, stretch it out over almost 30 years, and take a little bit each year as an expense and reduce your taxable income. Which, to your point, when we're doing that, that feels really nice. We can reduce our taxable income. We aren't paying quite so much in taxes. But what the IRS's thought process is, you're reducing ordinary income. You're reducing income that we would have taxed at the highest rates, not income we would have taxed at those preferred rates. And so later on down the road, when you go to sell that property, so if we paid $100,000 for it, and over time we've taken $10,000 in depreciation, and now we're going to sell it for $110,000, the IRS says, hold on a second. It's not that you paid $100,000 and you get to sell it for $110,000 and claim a $10,000 gain. We've got to go back and say, you took $10,000 of depreciation, and oh, by the way, we let you take that deduction at your highest rates. So now we want to tax it at your highest rates. And so a portion of that sale that was related to depreciation goes through this depreciation recapture. It's a whole separate schedule. We've got to go through these calculations of what it gets taxed at, but it's not by default just at those preferred capital gains rates. And so especially for people who have owned a property with a large value that had a lot of depreciation, or that have owned it for a long time. I've seen this before where people have owned a rental property for 20, 25, 30 years, and all they're thinking is, oh, well, I paid $100,000 for it. It's now worth $110,000. I've got a $10,000 capital gain. And they're shocked come tax time when they've got this massive tax bill.
Yeah. And the thing that I would want our listeners to remember is it's not the value of the asset that you get to determine the cash flow on as you're trying to do this analysis to see if it makes sense to replace the cash flow. Because again, retirement's all about cash flow, right? It's all about having enough income coming in to cover your expenses. And most people in retirement aren't thinking capital appreciation as much as they're thinking, how can we get the most cash flow? But when you sell that rental property, you have the costs and the taxes and the real estate broker's fees and things like capital gains and depreciation recapture. So what's the net amount of money that you have after all of that is taken into consideration? And that's the amount of money that we have to figure out, can we replace the income based on that net amount? So you really want to make sure that you're evaluating real estate in its entirety and not just based on what you think what you paid for it versus what the current value is. But Steven, this has been so much fun. I know that our listeners are going to love I'm sure you're going to get a huge influx of people coming to the Retirement Tax Podcast, because a lot of the people that we serve, a lot of people that listen to this show, they're really money nerds. In fact, we created a private group in our calculator called the RBC Nerds, where people can share ideas about retirement planning topics. And this has really been a lot of fun. Your new book is Don't Get Killed on Taxes. And so we'll make sure we have a link to that in the show notes for the people that want to check it out. Is there anything else that we haven't, we covered a lot in today's show. Is there anything else that you would like to talk about that we haven't had a chance to talk about?
Jason, I would just go back to a comment you made earlier in the episode, which is just an idea that recently got brought to my attention as far as how to phrase it. And that's this idea that small hinges swing big doors.
Yes. And
when it comes to taxes, where I see the biggest impact is consistent effort over time. Small hinges swing big doors. This isn't about setting up some intentionally defunct trust or setting up an account in the Cayman Islands and saving $1 million in taxes all at once. This is about finding those opportunities to little by little sand off the rough edges of your retirement tax bill. And so that's what I would encourage listeners to keep in mind, that these things add up over time. Taxes are painful. I get it. Most of the time we can't make them go to zero, but if we can shave off $500, we can shave off $1,000 or $2,000 a year, that adds up over time and gives you additional cash flow to accomplish the goals that you're really passionate about.
I love that. Yeah, absolutely. It's the little adjustments over time that make a big difference. It's not trying to do everything all at once. That's really good. Well, I sure appreciate you being a guest on Sound Retirement Radio. Thanks for being here today.
Yeah, it was a pleasure.
All right, take care.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.